On to earnings in Australia. For the last 3 years, we've been suffering downgrades in earnings relative to expectations. Analysts would start off the financial year optimistic about company earnings. Every month they'd downgrade, and sometimes they were still downgrading when the companies reported disappointing results. What's been significant in the last 2 weeks, the last 3 weeks I should say, of company results in Australia, they've come in a little above analysts' expectations. Not a lot, probably total earnings per share on average are about 1.5% above analysts expected, but just to see analysts being a bit too conservative rather than too optimistic. And the other good surprise in the company results in the last 3 weeks, dividends in total are a bit higher than analysts thought, so that's good to see. On valuations, if you value our share market as a price earnings multiple, we're back to about normal. But if you value a share market in terms of the earnings yield relative to interest rates or the dividend yield compared to the cash rate, our share market's still cheap. The good thing about our share market still is average dividend yields are about 5% and we have franking. I don't have to point out to this group that Australia has the best system of dividend franking in the world, introduced by a Labor government, improved by a coalition government, and it's by far the best in the world. Also, our company balance sheets are strong on average. Another feature of our share market is the listed property trusts, which are now called REITs, are getting back into the basics. They made huge mistakes a few years ago and had a terrible year for investors. But you would have noticed that listed property trusts delivered returns of 33% in 2012. And I think in terms of running yield and modest capital growth, they're back to where they used to be. So I can see our share market having some good upside potential, especially if earnings improve, and some of that will come about from cost cutting, or if the Australian dollar softens. And just on the Australia and America, I've said what people like about our share market still is that the earnings yield on shares, which in Australia is about 7.5%, is much higher than the yield on a 10-year government bond at about 3.5%. So we have a 4 percentage point spread between earnings yield on shares and yields on a 10-year government bond, and that's still fairly comfortable and attractive for shares. Interest rates. The cash rate in Australia has been cut back by 1.75 percentage points from its post-global financial crisis peak. There may be some further small cuts, mainly because inflation's very low and the economy's a bit soft. But I think the market here has been exaggerating the prospect for further cuts. We might see 1 at most 2 further cuts, probably only 1. But that's because inflation's very low. On term deposits and other types of bank deposits, interest rates have been reduced. And if you have term deposits maturing with a bank, shop around. The banks will try to get you to roll over at the first interest rate they offer you. If you make a fuss, make a scene, phone around, go onto the internet, you'll be surprised how quickly you get a better rate. Commonwealth bonds are selling at 3.5% yield on a 10-year government bond. I'm not prepared to lend money to the government in Canberra for 10 years at 3.5%. It just is too low. And I think those yields are lower than is sustainable. But I'd still like to have some bonds, some quality bonds, whether corporate or government, in a portfolio just to reduce risk. And just look at how low bond yields fell last year. They've kicked up a little, but still well below the long-term average. I'd like to say a word on house prices for several reasons. One is one of the wonderful things about being an Australian is we're always surrounded by 22.5 million experts on house prices. But also some interesting things have been happening to our house prices during and since the global financial crisis. As you know, average house prices here held up remarkably during the global financial crisis, and in 2009-2010 actually rose a good deal further. Then they were a bit softer, now flat again. My guess is our house prices have avoided the collapse a lot of people spoke about. And that's important for two reasons. A lot of Americans visiting Australia couldn't believe how expensive housing is here and were predicting a collapse. But given how low interest rates are, given that Australians have recourse, banks have recourse to the debts of Australian household, but most importantly, given our urbanisation and the way we like to own a house, I don't think we're going to see a collapse in house prices here. But it was also important for our banks. Australian banks lend heavily for housing. A lot of overseas investors were dumping our bank shares, feeling that house prices would collapse and that would bring down bank earnings and create problems for shareholders in banks. And I think those fears are now disappearing. So I'm not excited about prospects for house prices. They've gone up a lot. I think they'll be fairly flat. I think we might have a few years, a bit like we had in the 1990s, that house prices mainly move sideways or up a little bit, but fairly flat in real terms. But you know what also stands out in Australia, and I won't be able to go into this in any detail tonight, but our house price cycle's now largely out of sync with our share market cycle. You go back to the 1980s, the 1987 shares collapsed, house prices went up. The 1990s shares did very well, houses were flat. Early 2004, shares fell and house prices went up. And then since 2007, shares have gone down and houses have done fairly well. So the two prices are out of sync, which is actually quite useful. And if you just look at the left-hand side of this graph, the blue line, the sensational gains in Melbourne house prices during and immediately after the GFC. Then a bit of weakness, but basically now they're settling it down. Onto the Australian dollar. In my lifetime, I've made 3 monumental mistakes, huge and monumental mistakes. 2 I don't talk about in public, and the third is I used to try to forecast exchange rates. And when you think about it, exchange rates are the hardest thing to predict because an exchange rate is the ratio of 2 prices. It's one currency over another. So if one currency goes up, another can go down. The good thing about shares and property, they can all go up together or down together. But exchange rates, they're a ratio. The big influences on the Australian dollar are commodity prices, China's growth, interest rates, the US dollar against the other currencies, and the AAA status that is attracting overseas central banks and sovereign wealth funds to invest in Australia. But don't underestimate the significance of the US dollar in that. One of the reasons our currency has been so strong recently is the US dollar's been very weak, and the euro's been weak, and the pound sterling's been weak, and the yen is weak. At some stage, as the US gets back to better growth, confidence will go back into the US dollar, among other things, and I think you'll see our currency come off a bit. And that actually, I'm sure you'd agree with me, would be good for the economy, good for education, good for tourism, and good for the share market. But exchange rates are hard to predict, and I think, though, we'll see the Australian dollar a bit softer. Now, just very briefly, retirement policy before I wrap up. We often hear Australia's retirement system described as having 3 pillars. We've got the aged pension, which is always frugal. The aged pension in Australia is 27.7% of average weekly earnings. In a lot of parts of Western Europe, it's 60%. And guess who has the sustainable system? But the aged pension here will always be frugal and means tested. We have compulsory contributions scheduled to go from 9% to 12% of wages. We have tax benefits, though they've been cut back. So they're the 3 pillars we hear a lot about. But I reckon the 4th pillar is the important one, and that is Australians over recent years have been unable to join defined benefit superannuation. People that are joining the workforce now go into defined contribution superannuation. And doesn't that change the risk? It was lovely in the old days, if you had superannuation, the boss, when you retired, had to pay you for your life, right through to your death, and adjust for inflation, and you didn't have to make any tough decisions. Now it's defined contributions. We've all got to take a great deal of responsibility. The rules keep changing, and that's very unfortunate because Every time they change the rules, they make our superannuation and retirement system less effective, and the frequent changes of the rules make it very hard to plan ahead. Well, let me finish just on one last thought, and that's the next cycle in global growth and inflation. You don't need me to remind you that if you look around the world at present, there's a lot of slack, a lot of unemployment in the global economy, and inflation is low. And the reasons for that are quite simple: the lagged effects of the global financial crisis. If you look at most Western countries, unemployment's high, business activity's low, and inflation's very low. But you've now got these incredibly stimulatory monetary and fiscal policies that probably will gain traction over the course of this year. And of course, that's an expansion, rapid expansion in liquidity or high-powered money or base money, whatever you call it. And I really think we've got to allow that in the next 5 to 7 years, we're going to see a pretty big cycle in the world economy and in world inflation. Given how much stimulus is being pumped into the economies, for good reason, we've got to expect that it will start to have its effect. And if you can think 5 to 7 years ahead, prospects are that in that 5 to 7 years, there'll be a fairly big cycle in the world economy, and inflation will be somewhat higher than it is at present. And if you look at the balance sheets of central banks, just look at the red line here, that's the balance sheet of the US Fed. Since the beginning of the GFC, it's gone from about 6 to 7 trillion percent of US GDP to about 18% of US GDP. And look now at the European Central Bank. So central banks are pumping money into the system. That money's just lying around as idle balances. But when it starts to circulate, the risk is the world will have a cycle in inflation in the next few years. So as you start to prepare for the next 5 to 7 years, just allow that inflation globally could be more of a problem than it is at present. Not necessarily as bad as we had in the 70s, but enough to really eat into the savings of self-funded retirees. It's not time to wake up tomorrow and do something about it, but it's in the next few years, I think we've got to start preparing for a bit more global inflation. There are many uncertainties in the outlook, and there's still a fair bit of negative news in share prices. And in particular, global gloom is built into low bond yields, 10-year government bonds of 3.5%, as I said. But if you can see the fourth dot point, I think it's hard to say when confidence will return, particularly to the world economy and world growth. But when it does, we can expect a strong performance from shares and a turnaround in bonds. And for shares, stock selection is again more important. So nothing is cast in concrete, but I do think the next year or a couple of years will be good for shares, bad for bonds. We've got to be selective and also expect that the journey's never a very simple one. There are bumps on every journey. And what's the most important mistake investors make? This is, again, I could take my shirt off and show you the bruises because I've made these mistakes too often. But it's too easy for investors to take the current phase of the cycle in investment markets and extrapolate it ahead as a new trend. And don't you think if we have a very good year, people say, this time it's different, this boom will last forever, and none do. And if we have a very bad year, people say, the next few years will be bad, it's a new trend and it's a new normal and things will never go back to being happy. After 50 years of involvement in investing, I'm a big believer in cycles, and we've always got to be on the lookout for cyclical turns. And as I've said earlier, I think we're in the early stages now of a bull market in global shares and a bear market in global bonds. John, I'm going to invite you out to maintain law and order during the question time. But thank you very much for giving me such an opportunity.